Hi, my name is Byron Hebert, and this is another Tool Time update brought to you by your friends at PKF Texas and the Entrepreneur's Playbook. Today what I want to talk to you about is using a balanced scorecard in your business and why you would want to use it. A balanced scorecard is just that. It's balanced in that you can't take performance from one area to offset another. To be a high performance organization, there's certain areas that you need to perform in well all the time. And so we're going to talk about that, what we do to build a balanced scorecard. First, we want to look at what a high performance organization does. High performance organization in your industry. There's a lot of information out there. We can find that. We can get that for you. And we want to compare ourselves not to the average, but for the high performance organizations. And so in this example I've given you, we're looking at sales growth, gross profit, net profit, accounts receivable turnover, accounts payable turnover, and inventory turnover. So in our example, we're looking at the 12-month rolling average for a company. So regardless of the month, we're looking at the prior 12 months performance. And so we say sales growth. In our example here, a high-performance organization is operating at 5% growth every year. Our organization is at 4.5% sales growth. Not bad, so we're not going to be too worried about that one. Gross profit, a high-performance organization is operating at 30%. We're operating at 28%. That's okay too. Net profit, high performance organization 10%, we're at 8%. Again, we're not worried about that. Our accounts receivable turnover, high performance organizations running 45 days, we're running 60 days. That's 15 days over the high performance organization. 15 days sales in your organization could be a lot of money you could drop to the bottom line in cash flow if you can improve that accounts receivable turnover. So we want to look at that. We want to track that and maybe implement some policies to get that accounts receivable turnover down. Accounts payable turnover. A high performance organization is at 50 days, we're running 40 days. And so again, we're paying our bills a little quick and maybe helping us on cash flow if we can extend that out another 10 days. So we're going to look at that. We're going to highlight that in red and we're going to look at it. Our inventory turnover. High performance organizations in our industry are at 4 times. We're at 2 times. So we're not turning our inventory quite as much. We're building up inventory, which we're probably using debt to do. And so that's an area that we want to look at as well. We want to get our turnovers up to that 4 times and get our cash flow in line. So again, balanced scorecard, comparing yourself to a high performance organization using a 12-month rolling average and highlighting those areas where you're not performing like your peers in a high performance organization. This is Byron Hebert. This has been a Tool Time update brought to you by your friends at PKF Texas and the Entrepreneur's Playbook. Thank you.